Is it interesting that we are doing a podcast yet I'm I'm here in your place and you're not?
Yeah, it's a little Freaky Friday on a Monday.
Without a doubt. Well, we are going to be publishing this one a little bit late, but I am here, your host, Craig McGrother, the Director of Business Development of Lone Star Capital, alongside the CEO of Lone Star Capital, Rob Beardsley. How are you today? Burning it up in humid Houston, I presume?
Trying to stay cool, staying busy. Life is good.
Yeah, well, I know you haven't really been doing much, and I've just kind of been fake working a lot of late. So we'll finally do some work here on this pod and bring a phenomenal episode nonetheless. Want to start out with, honestly, something that's really crazy, which was something we don't really talk about often on this show, of course, but the Trump chaos. What were your instant reactions when going through that? And I don't know if you were as addicted to your phone as I am. I don't think you are, but I was glued to X and every other social media platform, YouTube, Rumble, the whole nine. But would love to hear your take and thoughts on that subject.
Yeah, in our friend group chat, as you saw, Teddy said, "Oh my gosh, Trump got shot," and I was sitting there working with my mom at a hotel restaurant because naturally, which something we'll talk about later, is talking about Hurricane Beryl. Naturally, we were at a hotel here in Houston because we were without power for almost a whole week. So that was really not fun and counterproductive. But anyhow, we're at the restaurant and I see that message. I look it up. It's real. It's happening. And then all of a sudden, you see other people in the restaurant start realizing that it's happening. You see the news get turned on to the TV. It's a surreal moment. It reminds me of Mad Men and Mad Men is a show set in the 60s and 70s when JFK gets shot. And in Mad Men, people saw it live on TV, that assassination, and people in the show, they were crying and big emotions and a big deal. Everyone, right? Men, women, children, and watching that from a disconnected viewpoint of watching a TV show about something that happened so long ago, you're kind of like, oh, okay, I get it. But this happening today and the way that it did, and with Trump, who's such a big personality and a big character, and whether you like him or not, has
On
been such a
live
big person.
TV.
He's been just such a big person in our lives. Uh, I mean, I couldn't help but to tear up and sniffle up, and my mom the same way. It was a crazy experience.
Yeah, to your point, I mean, it's nuts. I think there's many distinguishable moments where you remember where you were. So I've got a couple of them to list out. 9/11, you're probably too young, as funny as it sounds, because this is like the first sentient moment I've had where I was like, oh, I remember exactly where it was. I woke up. I was like in first or second grade, and I woke up, and my mom was just watching the TV. This is like two remodels in my house, family's house ago, where like there was like, not an open concept. I go out to that room, and you see that, and you're like, what the heck is going on? But you knew it was, very impactful. You knew it was a serious moment. And then we went to school later that day, and like the teachers made a statement and stuff. It was a somber moment. The other one, totally unrelated. I remember exactly where it was, where Barry Bonds hit his breaking of Hank Aaron's home run record. I was in Bend, Oregon. And I remember I was like, oh no, I'm going to go watch this. My siblings and cousins didn't want to come down. I was like, no, I'm going to watch history. And sure enough, boom, he hit it. And that was like the summer of when baseball was probably peak popularity, arguably, or maybe towards the change and, the shift from being going more from baseball as a country to football. But Barry Bonds breaking that record is big. And then this one, I was sitting in your bedroom, just about 15, 20 feet over here. And one of my very conservative friends, who, of course, won't say anything, is not in the friend group chat, but posted blah, blah, blah. I'm like, okay, what is this? Because, not that I disagree with him, but he's just very conservative.
He's
And
out there.
we know people on both ends of the spectrum who are always kind of posting hyperbolic stuff going on. And I was like, whoa. And I clicked on it, and I was like, and just how he handled the moment was absolutely nuts. But I'll never forget that I was in, your building here in your bedroom as you're gone, and I'm enjoying it following my holiday in Switzerland. And I was like, holy, is this real? And I was glued to my phone, calling, texting, just like in shock. And it's still kind of rolled over to today. And to about being emotional, I've gotten very emotional, I think several times, like, this is just crazy. for several reasons, of course. It's crazy to see that, but to have that on live TV is nuts. To see all the angles, and I don't know if the JFK was live or not, if it was tape delay, what was going on, but really just nuts on so many levels. But I think my core takeaways as we transition and kind of think about this moving forward is for anyone of his age, regardless of what you like him or not, it's impossible to not be in awe of him and fully respect him. To be 78, to have this much fight in you, to live the life that he's lived, and to have the fight, to get up like that, and to like do the fight was one of the most. I literally have chills when I think about this. It is one of the more iconic moments in the history of this country. And to think about him at 78, to have this much fight, energy, and gas left in the tank. You want to talk about someone living a full life? This guy has lived more than 100 lives seemingly. Like this guy is doing so much and has so much gas in the tank and has so much energy. It's out of control. So my takeaways, I feel like I have no excuses. I feel like this is just one of the most wild moments in American history. And I think it'll be something that, the kids look at in the textbooks, when we have children and stuff like that will be printed in history. And it seems like there's a very large populist movement towards just appreciating him. And honestly, I think this is going to probably linchpin him and slingshot him into winning the election, assuming he's alive and assuming that he keeps up this momentum. But he is really remarkable in many respects. You like his politics, you hate his politics. That's not what we're commenting on here, but just as a person, to have that much energy and to have that much fight is just remarkable.
So I took a more pessimistic take on the situation. And the reason why I wasn't crying, I don't cry, I'm too tough for that. But the reason why I was tearing up and just feeling really emotional was not because I am a Trump fanboy. Me, I kind of have my negatives about him when it comes to politics and actually effectuating the change that I would want to see in America. But
I probably like him a lot more than you.
You like him a little more than me, yeah. Anyhow, the reason why
I am a fan. I'll just say it.
Yeah, you're a fan, and I'm a fan too. I mean,
Frankly, if you're in the real estate business, sorry to cut you off. If you're in the real estate business, if you are in the market right now, I'm sorry, but this guy is going to impact probably your business. Like this guy is so pro economy, pro real estate. I kind of vote with my pocket and stuff, and he will be net productive to what we're doing.
Most likely, yeah. So, but yeah, the reason why I was emotional was because I felt like, wow, I can't believe that someone out there or something out there wants to hurt us this badly and just are wanting to do bad for our country and for us as a people. So that's really demoralizing, depressing. It's like, wow, we're struggling here every day to build our business, to live our lives, to try to have happy lives, to try to build good families and good communities and good friendships. And then there's this happening, and then people are trying to attack. So, I mean, I like your take on it as far as seeing the drive and everything. But yeah, anyway, that's enough of the Trump moment for me.
Yeah, well, as I said, love everyone. This is not to be divisive. But of course, it's just something that was frankly, an iconic moment in time that will go down. So thank God that he's okay. And obviously condolences to the innocent people who were tragically murdered and killed there, to the families there and whatnot. We hope that never happens. And I was very happy to see that RFK now is also getting RFK Jr. RFK Jr. is getting, of course, now he'll be getting Secret Service as we move forward, which is huge. I'm a big RFK fan as well, for the record. I think he's a great guy. I think he's got a lot of really awesome ideas. So on another note, that is that. We will segue, though, into the first topic we want to talk about, which is a deep dive into our agenda. So, Rob, if you don't mind just pulling up the deep dive into the Lone Star Capital Summit event in 2024, which is happening September 15th and 16th. Rob, do you mind screen sharing your computer, please? We can kind of just walk through this. Now that cake is slightly more baked as to what the event will be about, I really want to spend some minutes to provide what this event is all about and how we have tailored this event to maximize everyone's time. We go to events all the time. I mean, really more so myself now, but you've, of course, in your tenure in the business, have been to way more events than I have, as you have transitioned to the CEO role, and I've transitioned really fully just to the equity side of the business. You will be going less, I will be going more. And that's been kind of the theme this year, and we'll proceed like that accordingly. But want to go into the event specifically. Oh, that's like a maze right there. It's like a mirror. I want to go into what this event will be about, what you and Dosh have been cooking up and are starting to finalize. So if you can please deep dive into that, kind of scroll down. I would love to hear in your words what this will be like.
Yeah, absolutely. So you can see my screen, right?
I can, in fact, yeah.
Okay, cool. So yeah, so the Lone Star Summit, we're going on. Is this the fourth one now? I think this is the fourth one.
I believe it is, because the first one must have been in 2021. The first one I attended was in 2022, and the last year was
Then
2023. So
23, now
yes,
24.
addition.
Yeah, so it's crazy to say, yeah, fourth one. And this is our annual summit. This is our flagship event. Very exciting time. It's a culmination of all of our hard work as a company, as well as all of our efforts to curate a fantastic network. And not just network like, hey, I know this person, I know that person, and I'm able to get them into a room. These are true friendships and relationships. And part of the event is us wanting to highlight those relationships and say thanks to them, give back to them by putting on this amazing event, by inviting them to come, and of course by selling tickets to the public and inviting the public to come. But of course, this year is by application only, and I think that's a really cool level up for us because, yeah, of course, we could have summit after summit, year after year, and we could grow the attendee base, and we could grow into one of the big conferences that everyone goes to every year and have 1,000 people come. But the goal of this conference is not to make money. The goal of this conference is not to be the biggest conference. The goal is to keep it intimate and to, like I said, really have a culmination of the relationships that we built and the success that we, with our relationships, are enjoying. And by having an application-only process, we're able to hopefully bring in new people into this network and not just, hey, sold you a ticket and you came to the event. No, we want people to actually become a part of our network, whether you're a complimentary sponsor and one of our investors can invest with you and us, and we can have a reciprocal relationship where your investors are investing with us as well. That's obviously not a requirement, but that's obviously the goal of a network, right? The goal of relationships and networking, while it's good to be, of course, a go-giver, it's also about what do you get in return, right? And nobody does anything for free. So we understand that there's a purpose. We're not looking for the people that come to an event just to pretend like they're being productive and pretend that they're getting.
Yeah.
No, we know that everyone's time is super valuable, that belongs in this room, so we don't want to waste it. And the way that we don't waste it is by actually putting you in front of quality people that you can actually do business with and you can actually grow a valuable relationship with. So how do we do that? Well, this year we're back at the One World Trade Center, and we've got September 15 and 16.
Can you scroll down, please, Rob, so the screen shows? Okay, thank you so much.
Yeah, so we'll go with the overview now. So the kickoff is day one, Sunday evening at 5 o'clock. We're starting at the Carnegie Club in Midtown Manhattan. That's going to be...
You want to give a sneak peek of what the Carnegie Club looks like so people get a feel and flavor of just the level of gravitas that not only we like to hang out in, the rooms we're in, but where we like to associate and create a cultivated and intentional experience. Because it's one thing you say, oh, here's a room, but like if you want to think about like a quintessential high-end, very cool, classic New York look.
Classic New York vibe.
Yeah, this is like if you think about a New York lounge, someone really special with the jazz, this is exactly what you'd be thinking about.
Yeah, the Carnegie Club's really special. It's a nice big venue, 2 stories, plenty of places to sit, mingle, all that jazz. So we're going to have
no pun
a
intended.
whole evening. Yeah, seriously. Their Sinatra Saturdays are really great. And of course, we've got a cigar element. Carnegie Club is one of the few, not just amazing jazz clubs and midtown vibes like that. It's also a cigar-friendly environment, which is in line with our branding. So we want people to come and enjoy. And I feel like, obviously, cigars are not for everyone. I get it. I'm not trying to push everyone into a cigar fest, but there is something special about cigars in the way that it breaks the ice and starts a conversation, and you can instantly become friends with someone by just being like, "Oh, what are you smoking?" "Oh, bang," and then you're chit chatting. So for an introvert like me, that's a very helpful crutch, if you will. So at the kickoff party, we're going to have a special chat, a special talk by a special person at the kickoff party. But really, the kickoff party is to get everyone to just in a casual setting get to know each other, and because we kind of want to break the ice, if you will, before we get into more of like a suit and tie conference environment. So the idea is the first evening, plenty of time to mingle and get to know each other and kind of loosen up. So that way, on day 2, September 16th, the full day, we have all the bells and whistles for you to be able to get the most out of the event, which includes speed networking, our flagship debt and equity panels, which I'll explain more what those are, small group discussions, and this year we'll have a keynote by me, which is a funny thing to say because after all these years of hosting this event, I've never really given a big talk at any of them because the thought was, hey, this is Lone Star's event, so let's not make it a Lone Star show. Let's highlight other people. But this year, we're doing it. I'm going to give a nice talk, so be ready for that. That's going to be super fun. So, and also something that's not included here that we've decided to bring back after further discussion is the Shark Tank. The Shark Tank it has its highs and it has its lows, because when the Shark Tank is fun and entertaining and educational, it's a 10 out of 10. It's super great to be able to see someone pitch a deal to real investors who have money to put to work, and for those investors to ask critical questions, to praise the deal, to tear it apart, to critique the actual pitch of the deal. So it's an opportunity for everyone to learn, whether it's the presenter who's getting a firsthand experience, as well as the entire crowd who can participate and see the mistakes and what the presenters did well, and also hear from the investors themselves as far as what they're looking for the different deals that they're being pitched and what kind of questions they're being asked. So whether you're a sponsor looking to pitch a deal to your investor, you're learning from those investors, or if you're an investor, you can pick up some ideas as far as what are good questions to be asking and how to conduct kind of a deal conversation, if you will. So I wanted to kind of not do the Shark Tank this year because, like I said, there are some lows. It can be kind of the negatives that we've had where it's too long, it gets boring, it's kind of very niche and it doesn't really apply to everyone. So this year we're bringing it back, but we're going to make sure that it's quick hit, very engaging, and everyone gets a ton out of it. So that's going to be super exciting.
I wanted to dive through some of the items that you mentioned, the articles here. There's not going to be 2 keynotes, just 1 keynote. Is that correct?
Yes. Instead of 2 keynotes, we're going to do the Shark Tank instead of the second keynote.
I know one of our big investors was mentioning maybe doing a generational wealth conversation. Is that in fact happening anymore, or did that get scratched?
That's happening at Carnegie Club.
I see. So don't want to miss that one because that will be very special. Someone who's very pivotal and really just amazing to the firm. So if you're really no Lone Star, you may know who this is. If you don't, you should come and you can find out in real time what is going on with that. Speed networking. I just want to dive through every action item here. So speed networking is incredible. So the reason why we want to do the application process on this event is not so much because we want to say no to you or reject you or anyone who is a prospective attendee to the conference. The big reason behind that is that, as you mentioned, this is really all about networking and how we would want a conference to go, where it is in there. When we go to conferences, it is meeting, and then more meetings, and then probably a curated dinner, right, at night. So why would we not tailor our event around that? If you don't mind just scrolling back up so I can go through that line per line, please, Rob. So the speed networking, the application process is associated to our event because we want to make sure that you are paired together with people you can actually potentially do business with, or with people that we think would be a good connection for you to have one way or another. The collaboration is very crucial in the real estate business. So that's the reason behind the application process, I would say, because we don't want some random person to come that has no real impact, no use for someone like yourself who'd be coming. So we want to make sure that this is very cohesive together. equity panel, you're going to hear what very high level private equity shop managing directors are saying, doing, and are experiencing in real time in their portfolio and what they're seeking moving forward. And also, guess what? If they're there, you know that they're legit. And if you're an attendee of this and a sponsor, hey, there you go. This is someone who's literally trying to deploy equity right now for the foreseeable future at well-established shops. Okay. Debt panel, what is going on there? I think more than the equity panel last year, to a lot of people, they found the debt panel to be actually maybe more informative than the equity panel, interestingly enough. So I thought that was a very interesting takeaway that just goes to show the value that you get from listening to both of these. The small group discussions, this is where we go through problems that you may have, the wins you've had, the losses, or how you work through something. So this is a very good way to also additionally meet more people. And then the keynote, you're doing that. I don't even know what it's going to be about, but I'm excited for the 2024 and 2025 tour that you're going to have, because I know this is going to be fresh material. It's like a comedian. You get a new bit. You get a new Netflix special, right? So very excited to see what you're going to cook up in that regard. And then what we don't even have here is the following of this, which is, I think one of my top 5 dinners every year, doesn't matter what year it is going to be the dinners that we have at Reserve Cut leading into Barclay Rex. So the really cool thing is we're doing a cocktail hour. So all the people that you may have not met with, maybe the people that you met with before that you want to get some more words in, the lion's share of individuals will be at this event. Before we did last year was VIP and general admission. Now everyone who acquires a ticket, which is why they're slightly more expensive than the years prior, will be in attendance at these events. So we'll be
we're not gonna it's a great point. We're not cutting up the groups this year where there's the VIP group that gets to do this and then the general group doesn't get to do that. It's one ticket, one experience. We feel like it's going to be just a much better way to go this year, so I'm excited about that.
Correct. So you can meet with more people, and this is Reserve Cut, guys. This is like, if you want to think about a old school classic New York steakhouse, kosher for the people who need it, but the food is incredible. This is one of the most amazing restaurants in the city, in my opinion, and is honestly the only steakhouse that I actually want to go to moving forward, and I mean that wholeheartedly. I don't know if anyone else feels about this, but the best steak is probably the one that my dad makes in Oregon, or the one I try to make and replicate like my dad makes as well. So steaks are often not what I want to get, but this will be decadent, over the top, and Lone Star fashion style. And then if that's not enough for you to meet everyone at the event, you want to extract and get relationships and value from Barclay Rec, cigar nights, we close it down to like 1 a.m. So conversations, connections, networking. Guys, this is going to be one of the best real estate events. And you can get in and access to this in our entire network. People ask, oh, wow, you're really so cool with having your biggest investors there and whatnot. And the answer is hard yes, because we are confident in the product that we have. And by this gatekeeping process for the sponsors coming, we want them to be equally legit as well and have the opportunity to meet our network. So do you want to go through some of the speakers, the panelists, the names, the headliners, if you will, that will be in attendance? If you want, just mind scrolling up, please, Rob. We've got Ilya Gamer, absolute legend. I'm sure he'll be on the podcast soon. Alan Steinberg, biggest investor with Lone Star. He's amazing. Parker Equity, massive family office. You got Nate Lowy, one of the biggest and best debt brokers in the entire nation. Brad Waite, I don't know who he is, but I'm sure he's elite. And then Andrea, absolute legend. Okay, so let's go on.
Andrea will be fun to talk to at the Cigar at Barclay at the end of the night.
I'm sure he'll have a couple words. So, guys, this is going to be a really, really amazing event, and we would love to see you there. So, if you want to go through the application process, if you think, oh, maybe this event's not for me, I don't really know, have a conversation with me. Let me know what you're looking for and how we can accommodate you to actually make sure that this is the room that you want to be in and the people you want to be around. It is so important to get return of dollars, especially in a time like this.
Yeah, sorry for interrupting you.
You're good. I know the feeling.
Yeah. I just want to show Brad some love, because you're not familiar with Brad, but we're very familiar with Brad. Brad is at Greystone. So we've done, I want to say we're knocking on the door of $200 million in debt deals with Brad and Nate as a team. So they also are the platinum sponsors of the event. So Nate Lowy's Juniper Capital Group and Greystone are platinum sponsors for the event. And that's not because they paid a fee to be sponsors. That is because we work with them on almost every deal we do. So Nate is our exclusive debt provider. He's always with us as our strongest advocate. And then Greystone is our go-to both agency and bridge lender. So we didn't just go and get sponsors to the highest, we didn't bid it out to the highest payer, highest dollar. These are
No horse in the
everyone.
final.
Yeah, we really work with all these people. TribeVest, very good partners of ours, very close. They'll be at the event. Highly recommend people to connect with them. Pretty much anybody at the event can get value from TribeVest, so check them out. Rogers Gray is our insurance broker. They're really great. They've got their ducks in a row. They've done great things for us, and they probably can do something great for you too. And then Appfolio is obviously our investor portal, and we've been with them for years, and they're great customer service. So look at that. I'm not even paid for this advertisement, but I pulled it off anyway.
So, and for TriVest Fund of Funds, we all know that is the most recent kind of one of the more buzz phrases, the shift in the industry. If you want to speak with, the SEC attorney, if you want to speak with Travis, who, is a visionary in the space pertaining to the fund of fund world and just understands that business, these are the people to talk to. Appfolio, absolutely awesome portal, great. And then Rogers Gray. People ask, Craig, how do you get such huge discounts on insurance? Well, it's because Rogers Gray and the people there. So you don't want to miss this event. I know we're selling it and selling it more, but we just really wanted to fully flesh this out. Now that it's a little bit more baked, as I said, the food has been marinating, but now it's time to present it to y'all. It's coming up in about, actually it's the 15th on the dot. It's August, September, so it's 60 days away, guys. So this is the event you want to go to. I assure you, this will not be a waste of your time. Please, if you're going to go to a couple real estate conferences, this is the one you should go to. I mean that wholeheartedly. If you're looking to raise equity, if you're looking to meet fellow past investors, if you're looking to find sponsors, allocate capital, if you're an insurance provider looking for clients, whatever it may be, a vendor, this is where you want to be, guys. There's these massive conferences that are huge, that get the whole headlines, and they're fine and all, but I can guarantee you will meet someone that is important to you, that you can transact with, that will be high level. You will not regret this event.
Well said.
Switching gears now. I want to talk about the ups, the pros and cons, and the birds and the bees slightly of preferred equity. So what that is, it sits in the capital stack. But Rob, I would love for you just to break down what happens. Let's say if you've got preferred equity in the deal, whatever, you can make up the rate. If you want to talk about our deal Grand Riviera, which is almost fully subscribed. And if you'd like to have more information, email me, please. But how preferred equity works in the capital stack. So if a deal does really well, preferred equity juices it up. If the deal does not do so well, preferred equity will soak up all of the upside in the deal. With that said, Rob, can you just explain the pros, the cons, and the utility of preferred equity, and then maybe just as it relates to our most recent deal, which we for the first time did put a pref stack in?
Yeah, we've never borrowed pref in our firm history, but we are doing pref for the first time on Grand Riviera. So that's our first time borrowing pref. We have lent pref before, so we have experience with pref. We know it well, but our first time borrowing has now come. And the reason why we chose to use pref on this deal, whereas we haven't ever before, is because of a bit in the dynamics of the market today, where senior leverage is. So at the end of the day, pref is just another form of leverage. And what does leverage do? It accentuates an outcome. Like you said, if the deal does well, layering on pref is going to make the deal do even better. If the deal does poorly, then it's going to make those returns even worse. So it's it's like any other form of leverage at a high level. And at the end of the day, the way I look at it, there are some nuances to pref for sure, because you have the current pay, you have the accrual rate, and then depending on the pref structure, the current pay requirement, which is the amount of interest that you're required to pay every single month, a component or all of it could be considered a hard pay requirement, which means that you are in default if you don't pay it. And then there's soft pay requirements, where basically it's kind of like if you have the cash flow to pay it, you pay it, otherwise you accrue it. So there's different ways, and then there's different control rates, there's different defaults and remedies. So it's kind of an individual deal basis, but the way I look at it from the high level is how much all-in leverage am I getting, and what is my all-in cost of capital? That's really what matters, because actually, if you think about it, the pref itself doesn't really matter that much. You have to look at the whole picture. You have to see, what does my senior loan look like? and what does my pref look like, and then what does my all-in combo look like. Because if you have an amazing pref term sheet and it's the best pref terms in the world, but you have a really awful senior loan, it's like, well, it's a waste of time. That doesn't make any sense, right? So you just focusing on the pref alone is not going to work. So what do I mean by that? I mean, let's use Grand Riviera as some example numbers. And it's been a while since I've been in the numbers, so I apologize because I've been focused on other things, as you can imagine. But with Grand Riviera, I think the senior loan is coming in at something like 55% of cost. Okay, and then you add on the preferred equity of about 4.6 million. That takes the all-in leverage to about 70% of cost. So you can't, again, look at the pref in isolation. You can't say, oh, you're borrowing $4 million of pref? That's so risky. Or, oh, that sounds great, because you don't know. You need to know what the senior is, because you need to look at the all-in leverage. So if I say the all-in leverage is 70%, that means if I take the debt amount from the senior loan and the pref amount from the pref lender and I total it up, that is my all-in loan effectively, or my blended. And if that's at 70% of cost, I feel pretty comfortable, because 70% LTC is, I mean, I can't say that's low leverage. That's definitely not low leverage. But for a transitional deal, we're spending a lot of money on renovations and we're increasing the value of the property, I feel very comfortable there. And most of our investing community would feel comfortable at that leverage as well. If you're talking 80% LTC, now that's high leverage. That's kind of the leverage of a couple years ago, right? People aren't really doing that today. So it's kind of relative, and you got to look at that holistically. So that's leverage. Then you have to look at the blended cost of capital, right? Because people can not fully understand how pref works, so they can understand, okay, so the pref costs, let's say 14%, and that's expensive. And they might get sticker shock and go, oh, well, I mean, 14% for debt, that's a lot. But again, you have to look at the weighted average cost of capital. You have to blend it with your senior. So if you have to borrow pref at 14%, yeah, that's not fun, that's expensive. But if your senior loan is 5.5%, and you blend those together and your all-in rate is 7%, I'm just throwing out random numbers, but obviously people who know a little bit of math can actually do the blend, right? You take the amount of debt multiplied by the rate for that debt plus the amount of debt multiplied by the rate for that debt, and then you divide it by the total. So if you arrive at an all-in cost of capital of 7%, that's a lot cheaper than a bridge loan today. And therein lies the problem. And that's the challenge today, is if you need to do a bridge deal, borrowing bridge is pretty much prohibitive, because SOFR today is 5.3. Yes, the Fed's going to lower rates and that's all going to happen. But today, SOFR is 5.3%. A tight normal spread for a bridge loan is 350. So what's 530 plus 350? It's 880. That is 8.8% all-in rate. That's a lot more expensive than 7%. So people are running around doing bridge loans today at effectively 9%. Yes, SOFR is going to come down, but 9% is a lot more expensive than 7%. So you have to look at your blended cost of capital. You have to understand the big picture.
So what happens to a deal, Rob, hypothetically, where the IRR is a 10 or the IRR is a 20? So what happens to the common equity? What does that mean?
So if you're talking about a deal that, I mean, you'd have to just plug in the numbers to look at it, but I don't know. I would say that if you're layering in 10 points of pref, that's probably going to exacerbate your returns in either direction by 2 points or so. So without the pref, if you're looking at a base case of like 14, okay, well then it juices it up to 16. But if the deal goes poorly, then maybe you're looking at a 12.
So, that said, if your deal, you have full conviction, maybe you want to take all pref, because theoretically, on every dollar after that threshold, it's 100% to the sponsor, to the operator for that dollar there. If the deal doesn't do well, then your common equity is gone or your upside is totally eliminated. So as you said, leverage, makes returns look great or makes returns go awful, right? So just something to think about here in deals. Obviously, we're applying it to our opportunity Grand Riviera in Dallas, which is almost fully subscribed. So if you are interested in that deal, let me know. But just wanted to kind of go through that concept there because a lot of people have been getting burnt by pref. People have been getting burnt by bridge loans, and people are getting burnt by floating rate debt opportunities, which segues perfectly into
Yeah,
an
well,
article.
let me actually. I want to share two things. So first of all, one funny comment is we have one of our private equity firms that has partnered with us before, and we showed them Grand Riviera and we said, yeah, we're doing pref on this deal, and it's actually at lower leverage than what we originally wanted to do on a bridge loan. And so the funny thing is in my eyes, it's because we're doing the pref route, we actually have lowered the risk of the deal because we're going cheaper cost of capital, lower leverage. Same or lower leverage, right? But this private equity firm basically has a new policy today that's no pref, right? And I think that, and they admitted, they're like, yeah, I know this is not smart of us, and this
He
is
was
kind of,
not thrilled by it. He was actually, this is stupid. This should be a rare exception where it shouldn't. He was ready to greenlight it and put all the equity to us. But
it happens,
man,
life happens. But the reason why he felt it was stupid and the reason why we agree is because, again, it's that whole thing that I just explained. Like, pref itself is not evil. You have to know what the all-in leverage is. So if you're borrowing pref, yes, that is supplemental leverage, and supplemental leverage is more risky than not using supplemental leverage. But if you're grossing up leverage to 70%, that's not necessarily any riskier than just using a senior loan that's at 70% leverage. So that's a little bit of an inconsistency, but it's funny because it's exactly what you're talking about, which is recency bias. People have been burnt by bridge loans. People have been burnt by pref recently, and that's causing them to not be able to look forward because they're stuck looking in the rearview mirror, even though today is the day to be taking advantage of opportunities in the market and to be slightly turning more aggressive. And one other anecdote is there was an investor that flew in to Houston, I think last weekend, and I met with him, and he was in town because he was working on a deal here that is one of those unfortunate situations where the equity's wiped out. And this is a situation where the sponsor borrowed bridge and pref. So this deal is levered to the moon.
well, how much
And
total equity was in the deal then? With that said, what was the deal size?
I
What
don't
was
know.
the company?
It's like an $80 million deal, and I don't know. They put in like $6 million of equity. So today, just on today's valuations, that equity is wiped out. That's long
And
gone,
then, and then some.
and the pref is wiped out.
Bad day to be a bad day.
That's not good. So
No.
anyway, that's why people are stuck today with negative sentiment, even though when you look at numbers today, deals are not everything, but some deals look very attractive. And also, quick shout out to a deal that we have. I know I'm speaking a little out of school here, but we've got another exciting deal that we're working on that we're going to be announcing soon. Sorry to Grand Riviera.
Yes. Well, you know what? We're very excited about that deal. However, we can't speak too openly regarding that deal because there are structures in place, 506Bs and Cs.
The
We've been able
SEC is
to
getting involved.
Yes, of course, the SEC, and I'm not talking about the best football conference in the world, who is acquiring the Longhorns in Oklahoma. My
That's
beloved
nice.
Arizona Wildcats are migrating to the Big 12, which may be also acquiring Florida State as well as Clemson and Miami, but that's neither here nor there. That said, the SEC has regulations, of course, which is 506B and C. A 506B is a private offering for sophisticated investors. There's allowed to be about 35 of them per deal. And this deal will be a 506B. Why we like these opportunities, we've got a lot of incredible investors who are not quite at the accredited status yet. It's also a little bit more of a private process, which I think is very much so in lockstep with who we are at Lone Star. We value relationships, and we don't want to kind of spam the deal out everywhere, but there are case and points and reasons why we want to do a 506C. Grand Riviera, why we've been able to talk about it, of course, is because it's been a 506C, which is available for accredited investors only, of course. So I just want to make that distinguishment right there. That's why we can't talk about it. But if you are looking to hear about our deal flow as we turn to the second half of the year, we'd love to connect with you. We've been very busy. We've been very active. And guess what? Our deals have been getting funded Funded. We were talking today, and you're asking, wait, you filled up the capital stack almost already? And as a matter of fact, I almost have. I think there's a very, very small sliver left in that opportunity. And not only do we have this deal almost fully spoken for in equity, but it's the partners that we've elected to. Okay, these are people that know Houston like the back of their hands, right? But they they're saying yes to that deal, which only speaks to the caliber of opportunity this is, because guess what? Better partners select the best deals, and it really just shows to how awesome this opportunity is. So we're very grateful for that. Switching gears, though, unfortunately, to people and deals that are not doing very well. There was an awesome Real Deal article that I read, which I think we're going to start incorporating that publication, because so many of investors actually email us articles like that. They want to know what's going on. They want to hear our takes. They want to hear our responses. So we're going to be talking about those articles moving forward more. There was an article published on July 12th pertaining to multifamily CMBS distress nearly triples in 6 months. So that is what the article would be. The biggest stat that I saw here and headline that I found to be very fascinating was this quote here from the article. At the end of May, 46% of all CRE CLO loans were in some type of distress, either watch list, specially serviced, or delinquent, according to an earlier CRED IQ report. That is nuts. We've been talking about this, of course, on this podcast, so this shouldn't be news for anyone who's been listening to us for a while. These have been some of the themes that are going to have to be worked out as the economy ultimately, and I guess the commercial real estate world changes due to the recent spike in debt, of course, over the last couple of years. But that is nuts. 46%, basically half of loans that are, in that profile are screwed and need workouts and need capital going into them. So we'd love to hear your reaction and what that means for you, Rob, and how it lands.
Yeah, crazy statistic, and it's true. So the reason for this is CRE CLOs stands for Commercial Real Estate Collateralized Loan Obligation, and these CRE CLOs are the capital behind bridge loans. And the way that works is a lender makes a bunch of bridge loans, and then they slice and dice them, package them up, and then issue bonds, which are CLOs. And then you've got CLO investors who buy the bonds, and then the lender is trying to make a spread, right? Because of collateralizing these loans and cutting them up into A, B, C tranches, what have you. I don't know if they actually do C. I don't think they do. They can sell those bonds at tighter spreads. And then they basically lend out the money at a bigger interest rate, and then they pocket the difference. So that's how bridge lenders or debt funds make their money. And like I said, this loan product in this structure is only for bridge loans, which is why it makes sense that about half of them are in distress, because, yeah, if you are a part of a bridge loan deal that occurred over the last 3 years, it's most likely a problem, unless it was, I would say, within the last year or so, maybe the last year and a half, honestly. So it's all starting to happen from kind of the 2021, early 22 time, where things were out of control and things were over levered on the basis of uber low interest rates, and that those interest rates were going to stay. And then, of course, they didn't, as we all know.
Or
and as
at
we've
least
covered.
not raised to the clip that they rose in that very condensed period of time, the quickest spike in interest rates in over 40 years.
Yeah. So it's been a whiplash, and it's been a tough situation for floating rate borrowers, not just for CRE CLOs, so not just bridge loans, because there's other floating rate loan products, for example, like agency floating rate loan products. But the difference with CLOs, of course, is because they're bridge loans, they're often most likely made at a higher leverage point, which only adds to the challenges and likely distress. So the other thing that's interesting here is bridge loans are typically 3-year terms. So if you borrowed a bridge loan back in 2018, that loan's been paid off. If you borrowed it in 2019, it's been paid off. If you borrowed in 2020, it's likely been paid off unless you exercise an extension or something like that. So now that we're getting to be 3 years removed from the peak of the market, I'd say the peak of the market occurred basically H2 of 2022. And we're now, H2 of 2021. So now we're 3 years removed.
Yeah, Q1 of 2022 is probably the peak.
Yeah, maybe you're right. So basically,
because
end
because
of
prices
end of
full high, and then debt was starting to creep up, but it takes a while for pricing to change, cap rates to change,
yes,
regardless of a rate increase, right?
right. So end of 22, early. Gosh, I'm not doing well today. End of 21, early 22, somewhere around the peak. So we're approaching 3 years removed from the peak. So everyone who borrowed around that time, before and after, slightly, now has to deal with not just a suffocating interest rate because of the floating rate issue that CLOs present, but also a maturity issue because these loans are coming due. These lenders want no part of these loans. They want these loans to be paid off every which way. So these loans, unfortunately, are going delinquent because borrowers are struggling to make the ongoing payments. But that's one challenge. The whole other challenge, even if you are able to maintain paying the mortgage every month, is how you're going to pay the loan back, because we're in a different world now where cap rates are higher, interest rates are higher, and loans size based on different metrics, and you're not able to get the same leverage as you could before. So you're dealing with a lower valuation and a lower LTV on that lower valuation, which makes it really hard. If you borrowed a $50 million loan in January of 2022 and it's time to pay it off in 6 months, the max loan that you probably can get today is maybe 35 million. So you've got a 15 million, and I'm just using representative numbers, but it can vary obviously depending on the location and the project and how well you bought and whatnot. But let's say it's a $10 million gap, right? Like you borrowed 50 and the max loan you can get now is 40. You have a $10 million gap in your stack, which is now where people are trying to fill that gap with pref equity or a capital call or some sort of gap financing, some sort of rescue product. And that's the challenge. And so I think this, while this headline is definitely alarming, it's nothing new. We all knew this was coming. It was just people are kicking the can down. And guess what? If you can't pay off that $50 million loan because all you can borrow is 40, and obviously you can't pay off 50 with 40, well, you know what they say, right? Oftentimes the best lender is the lender you already have. And so that's why a lot of people are working with their existing lender, and they're trying to extend and pretend. They're trying to do loan modifications, trying to get more term. So even though the loan's due now, they're trying to exercise an extension option or negotiate a new sort of extension agreement. And those are all things that are really important to be working on if you find yourself in a troubled situation, because right now, what the market needs in these distressed situations is time. You need time and money. So the way that you can get money is you can get it through a capital call, you can get it through external equity infusions, you can get it by asking for the lender to do forbearance or to accrue some of the interest to the back end of the deal. That buys you money. But what you need is you also need time, right? So you need to be able to buy time with your lender so that the market can improve, so that interest rates can come down, and so that you can push the income of your property.
Well said. Yeah, and I mean, there's regardless of how many rate cuts may or may not happen over, call it, the next 12, 24 months time, I don't think there's going to be enough to unwind the problems and what needs to be digested in the marketplace here coming up. And we're going to get into the next topic we're going to speak about is Pensford's letter, which came out this morning, of course, which basically referenced, and the lead of this was the following: markets are now pricing in a 96% probability of a rate cut in September, and just a 6% probability that the Fed's fund rate is above 5% at year end. So this is obviously something really important, and this tethers perfectly together. Regardless of a rate cut or two or three, perhaps, if we get, maybe a 25 to a 75 basis point dip in rates currently today, that will still likely not be enough to bail all the water out of your boat. So there will be distress coming up, which will equal really sweet investment opportunities from this year and likely till 2026. And obviously after that, there's still going to be awesome deals to be had. But the sweetest and most ripe opportunities are today and probably maybe for the next 12 to 6 months. JC made the claim that the best deals in that window is gone. In our podcast, of course, if you want to reference that back to October of 2023. But that said, Rate cuts are seemingly coming close because the metrics that the Fed is seeking, which is about, what was it, 2 or 3% they need to get inflation to, it's coming close to that and slowing down. And jobs are not as hot as they are being reported. So love to hear your comment as well on that one, Rob.
Yeah, let me just unshare. We don't need to stare at an article, but yeah, I mean, the Pensford letter is great as always, and it's unfortunate that we happen to be right, because we've been saying this for a long time. We've been saying that inflation is not as sticky as the Fed has been claiming. We've been saying that the numbers are going to turn. We've been saying that the labor market is not as strong as people claim it to be, particularly how the Fed claims it to be, right? And so, as we talked about last week, the Fed tends to under project the path of rising interest rates, and then they pretend to under project the path of declining interest rates. And so that's what we're headed into. We're now headed into the easing cycle, which is going to begin in September. September is going to be the first cuts, and then we're off to the races. So we kind of all knew that. My prediction almost a year ago was that the first cut was going to happen in May, but I was giving the Fed too much credit because I thought, like they claimed, that they would be data dependent. The data was saying that they should cut in May or June, and they've been holding off. But I can't be so negative on the Fed, because they have to kind of always provide a head fake, because if the market feels like they have the Fed figured out, then the market is going to loosen financial conditions in anticipation of rates, and then that rate cuts. And then that defeats the purpose of hiked rates, right? Because the Fed needs to talk up. No, we're going to keep rates high forever. We're going to keep rates high forever, because they want to bring pessimism to the market, because they want to cool it down. They want to cool the job market. They want to cool inflation. And they've succeeded. And I think they've succeeded so well that we're going to have a recession. And they are basically cooling the market so much that prices are coming down, and the job market is not hot. If you really look at the numbers, and if you look at non-government jobs, there's actually not a ton of hiring going on. So that is a concern. And so for me, while as a real estate guy, I'm excited about rate cuts, and I'm excited about the interest rates that we're going to be able to borrow at now and coming soon, I worry about the NOI of our properties. I worry about, okay, well, if we do have a recession, how are our tenants going to be affected? Are they going to be able to pay rent? Are we going to be able to raise rents? Are we going to be able to collect? Are we going to have a delinquency problem? So I don't worry about, I don't lose sleep over it. Like, I don't think that it's going to have a major impact. I also don't think it's going to be a major recession. But building on your point, I don't think that the Fed starting to cut rates in September is just a get out of jail free card for everyone who's got problems in real estate, and that's valuations are going to the moon. It's going to take some time from the first cut before things start going crazy again, which
And things will progressively get worse, in my opinion, for the foreseeable future. Like we're in probably the second inning of this distressed cycle period, perhaps, which means we're talking about things not being normalized or feeling rosy or optimistic. Things depending on who you are and what company you're with or where your investments are. You may not feel good about things for a very long time. If you're with sponsors like us, of course, you're probably feeling pretty solid about everything right now. But I don't think the sentiment will feel good until 2026 is my guess. So that's why I say we're in the second inning of things. I don't feel as if this is an overnight thing. The beautiful thing about real estate, unlike the stock market, is it's a slow moving, asset. It does not trade overnight. There's not an ongoing stock ticker. These trades, when they do happen on these deals, take 3 to 6 months to transpire. These are not quick overnight processes. This is not, buying and selling, Apple stock. So it's going to be a very slow unwinding process. You mentioned that the government's done a lot of hiring. Clearly, they haven't hired enough with the Secret Service to allow what happened, of course, on Saturday happen. But with that said, we appreciate you being on this episode of the Capital Spotlight podcast, Capital Spotlight, the Lone Star Capital podcast.
amazing.
I know every now and then, but the Lone Star Capital podcast. Thank you so much for being here. If you have any questions about Lone Star Capital, if you're looking to find an operator like us to work with, my email, but I'll say it once more. It's craig@lscre.com. If you're looking to learn more about the event, if you're an operator, capital allocator, passive investor, or vendor, the email, you know it once more, it's craig@lscre.com. Any final thoughts, or should we leave them with that?
Good work.
Awesome. Well, thank you so much for attending. We'll see you next week.